It was every single angle, 2023 and the beginning of 2022. Hardest year and a half that I've seen in that industry. These are the best deals we've seen in a decade. This is the exact same thing we did in 2008. When everybody else was running, we were not only buying assets, we were investing and building a company around those assets. This is, in my mind, our 2008 period. This is going to take us to the new level. What's up, everybody? We are going over my financials and my businesses. So I wanted to give an update and really dive into what has been going on with our firm, with our businesses, and give you guys an overall outlook. Now, 2023, everybody sucked. It was a bad year. There's just no ifs, ands, or buts because we are in one of our main business, the largest business that we have, which we'll get into it, is we buy, own, operate, build, develop storage facilities. And 2023 with rising interest rates was a really hard year for storage. Hardest one we've had probably since the Great Recession. And these cycles are normal, but it was tough, really tough. So we're going to get into that, and we're going to get into updates on that. I'm going to talk about my other companies, how those things are affected, and how we look at cash flow in our business and what we do. A lot of things that we just don't talk about. So I want to talk about them today because I think it's not only interesting, but I think that it'll help people understand a lot about our company. So let me give you an overlay. We have an array of companies in the self-storage space. We call it our ecosystem, right? It's a universally integrated, we call it, system. Vertically integrated means you have all the pieces to execute. So you have a business. Let me give you the example. We have our private equity side, which is Cedar Creek, which that means we raise capital from individuals and we invest it, right? That company, we have a development company, an architecture company. We have a brokerage side. We have our all of these functionalities to execute acquisitions. We have our investor relations team, right? Those are all within that Cedar Creek ecosystem. Now, the other side is what we legacy refer to as Bitterroot, which some people might know what that is, but it's really self-storage admin. Self-storage admin is the operational company that runs our storage facilities, property management. All right. Now, within that, we have another third party, which this is companies that we are the largest investor in, which includes our tech stack. And that company is based out of Southern California. And that company is also tied with Store Local, which was a co-op that we were founding members of. Those two companies. So there's those three parts in our storage business. The Cedar Creek, that is my overall company that has the other companies I just talked about in it. Then we have the Bitterroot, self-storage admin, all property management. Then we have Tenant, Inc., which does our tech, which is our software product. And that software product that we have it's a company that goes out to the market. We allow everyone, obviously, to use it. There's lots of investors in it. We have a CEO, the founding member, who is Lance, who's been on our podcast. You guys probably know him. He's one of my best friends. And they've absolutely killed it. And that is something we are obviously very involved in. We're the largest investor in it, and we have been since the start. That has been something we've all been working towards at Store Local, our co-op, which is founding members of a bunch of large storage operators. That gives us a lot of advantages. All right, so that's a layout of the three main companies that go into our storage business and the sub-companies under them, okay? Now, how I'm going to break this down and explain this is there's two sides of our business, okay? We have the investment side, the investments that we own, and then we have the business of storage. That's the easiest way to think about it because we own the asset and the asset produces income. But we also are in the business of storage, right? So we get paid for doing things in the industry and we get paid fees for that, right? Or we may even get equity for that. And that comes from everything like doing feasibility studies and analysis, which is a part of our company, which we do for other people to tell them what their location looks like, if there's supply, demand, all of that kind of stuff. They pay us They pay us 10 grand and we have our people do a study report. They can give that to banks. They can give that to lots of other people, which banks, things like that, they require these feasibility studies to be done. So we have all of that. Now, sitting as a base of it is my self-storage income educational company, okay? And that fuels opportunities for us to find deals. Self-storage income is what a lot of you have probably seen from me on the storage side. I view that as our outward-facing part of the storage industry. We have the largest platform in the industry, the largest podcast, the 2 best-selling books in the industry, which I just rolled out our new one, which is 400 plus pages, 430 pages. It's a behemoth. It's a textbook on how to do storage. I built that after I got out of the hospital, and I tried to share my knowledge with others. Now, virtually everything we do for that is free or minimal payment. Like if you go to buy the book, you have to pay for the book, but right now it's like $11. Well, that $11 is fixed by Amazon. I can't even drop it lower because that's the printing and shipping cost. So I have no control over that, but I have to put a price. So we do that. And the digital one is at $1. Now, so a lot of this stuff we do at cost or we send out for free to people. That includes podcasts, YouTube videos, things like this. A lot of people have asked me in the past, why do you do this? Why are you transparent like this? Why do you give away your air quotation secrets? Which in a 430-page book on storage, I really do. And on these podcasts, I want to be transparent. The reason being is, for us, it brings in opportunity. Now, that got super expensive to do. When I was doing self-storage income and we were giving away everything for free, it got to a point where I was spending $10,000 to $15,000 a month to give away our secrets, to which my wife asked me, said, hey, AJ, like, I'm okay with this, but maybe we shouldn't be spending $10,000 to $15,000 a month. Could you maybe make that break even? So that's when we built out my inner circle, which was my private group for people that wanted to learn about storage from me. And they all get on and I teach them all. They come out here, everything else, that's a paid part of it. And so then we add those paid products into self-storage income. So that became that business. Now, when you look at this ecosystem that we have, you can see all 4 legs of our stool. We have our private equity, property management, our tech, and our platform. That drives opportunities to us. That allows us to buy, to do the private equity side and get them. Self-storage income has always been the marketing arm to fuel our business, and that's how we've made money. That's why I didn't care about making money, or when I was spending $10,000 to $15,000 a month, I looked at it as marketing spend. So when that it becomes a circular thing. Now, that works really, really good. We got investors from there, everything else. That has been our business for the last 5 years, the main core of it. I have other businesses and personal assets, which I'll talk about. But we're going to first stay within the ecosystem of storage that I built. This ecosystem of storage and all of these different companies, I continue to add to it. I'm building new software products, things like that. Optimizing the whole intentionality besides what we own, allowing other people to get into the industry. We did with Tenant and Store Local, where we're giving the technology and operations in a box, storage in a box for others to do it. We're trying to lift up the industry. We've always done that. We've always given our time, sit on boards. We speak. We do all those things. It's very, very important to us because the industry is very important and we want to be involved. So we are very entrenched. And that me becoming kind of the face of that was not really expected. When I wrote my first book, self-published, I did not actually expect anybody to really read it. I did it as basically a giveaway, but I did it right. I spent a lot of money on it and a lot of time. And I said what nobody else was saying, and I told, here's the secrets. Here's exactly how to do it, which hadn't been done before. And that became a bestseller, and that fueled everything from the podcast on. It just happened. It wasn't something we necessarily planned on. And that fueled our business. So I kept diving into it more. Now, 2023 when interest rates went up, which actually started in 2022, the end of 2022, we had the largest drop in self-storage history as far as occupancies not occupancies, rates go, but occupancies were dropping as well. Now, our personal portfolio makes up, which I'm going to talk about. We have a total in our portfolio right now of like 3 million net rentable square feet. And that is across 2 funds, lots of different acquisitions that are individuals, syndications, not funds, and our legacy facilities, as we call them. Those legacy facilities are my 3 partners, Ron Osborne, who is my father, and Sam Whitaker, who is our partner. We are partners on all of this. We've been partners on all of this since the start, and we've built this up together. Those legacy facilities are ones that we bought, and we never even had investors. We didn't start taking investors till like 5 years ago. That was new. We've been doing this for about 20 years now. And so the legacy facilities are strung across the Northwest and Nevada. And the rest of them are from the Northwest to the Southwest to the Midwest. And what we found in our 8, 9 states, whatever it is now, and in these large metro areas, we have first-tier markets, large second-tier markets, and then some third-tier markets. 2022 came, rates dropped, right? We were affected like everybody else was, and we had to really dive back down into operations. But the cash flowing assets, everything, they're fine. Where it actually really affected was the business part of self-storage. So in the business part of self-storage, we do deals, we make money, we syndicate, people invest. A lot of that just stopped. I mean, it just ended. The deals that were on the market were horrible deals, not good ones. So we started doing all our work for off-market deals. And we did very, very few deals, but the deals we did were amazing. And we started to do developments because everybody else was shutting that down. And so we're very contrarian by nature, and we started to really move forward in that way. But the investor side, that really changed. So as interest rates went up, money just evaporated out of the market. Accredited investors, which were our primary draw because we were giving opportunities to them, they stopped investing kind of across the board. Everybody got scared. Everybody's not sure what to do. So where it was really easy to raise lots of money before, it became harder. That meant we had to switch over to more of a new model where we want to give opportunity for accredited investors, but we need more foundational investors that allow us to just keep our machine going and buying, and we don't have to wait. We have multiple investments that are still funding, and how we did it is we bridged the gap and used our personal cash to fuel these things and to buy them so we could get them and bring them on board. And that was 22 and 23. Now, that meant, though, that the business of self-storage was less than 50% of what we were doing the year prior. So that was hard. That sucked because we're all sitting here going, let's do deals. We want to move. Now, at the same time, the industry was changing. So we were reconstructing. Then we had to reconstruct how we went about business, how we attract investors, how we managed assets, because that whole thing had changed. So it was every single angle 2023 and the beginning of 2022 were. The hardest year and a half that I've seen in that industry. Now, this happens in every industry and ongoing. It's something we're used to. We've been through 2008, and this was nothing like 2008. Once again, our assets themselves are fine. They're all stabilized. They're up. I'm looking at it right now. I mean, you're talking in the net month move-outs, which is not even how many weeks here, move-ins. We have a net move-in of 225 people. So we're moving in tons of people. That includes the people that left. So our actual move-ins were like a lot more than that. But then we also had people leave, but we're still net 225 up so far in the month. We had one day last month where we rented like 300 units net positive in a day. That is the equivalent of a large facility. So the assets this spring are doing good. We felt that we've come out of it. that sluggish. We're raising rates. We started that in the fall and being very aggressive. And we started using our new dynamic pricing system, everything else. So the assets, right, once again, they're moving up. They're doing good, which is a great change because the last two, what we had is in 2022, we saw the occupancy and rate drop. In 2023, when the busy season, which is spring, it didn't come. It just didn't. So like all of a sudden it was like, we're not filling up. So then people started to drop rates even more. So that made for a really tough year and a half, obviously. Now this year we've seen that change, that cycle and move around, which that's awesome. That's great to see this spring. It's a huge relief. Now, with that said, though, our cash flowing assets were cash flowing. We never did a capital call. We've never done that. We've never had to do anything like that. We're conservative when we're buying. But during that time, we were also changing the model and our tech stack that we were using. And we were worried that all the changes with the market, that may have hurt the assets. So we actually didn't take fees in 2023. We just said, no, we're not even going to take any. That meant that we actually had to fund the businesses out of our personal pocket. We didn't have to do that. We didn't have to not take fees. That was just a personal decision that we made because we thought it was right to do and thought it was a good thing to do for investors. There was no need for us to. We didn't have to give capital to the assets so they would survive. Nothing like that. We just wanted to help out, and it was our job, and we wanted to make sure that it ran as it could. So we thought, bad year, we're just not going to take fees. And that a lot of people are like, oh, that means you didn't have a profit. No, that's not how it works. In that company, we haven't had a profit. We didn't have a profit. So that is the syndication arm. That meant that the $2 million or $3 million, we funded the companies out of our personal bank account. It's not that it didn't have profit. Very different. We actually had to fund all of the expenses, payrolls, operations, everything else we have, that we have to do and run to run and optimize. These people are working, traveling, everything else. We took care of it all. Now that was fine. We did that 2024 this year. We've seen things going up back in the asset side. Things returning normal. We're taking our just normal fees. We started that on. It's not something we really talked about because I didn't want it to be like a braggadocious thing or something like that. I think that was actually a mistake. We should have. A lot of investors didn't know we didn't take fees, because I'm not trying to rub it in anybody's face or try to make it anything like that. But it was just something we personally decided to do. Now, when we look at this year coming out of all of this, we still need, though, the business of storage to move. We need to still be doing deals. We need to be getting investors. And we had to completely change the model up. So the model that we had to change then from investors, because there's no investors. So we're buying deals, and accredited investors, there's just hardly any that want to fund deals. The market's scared. So we're moving and shifting over to more family offices and things that have the money that want to put it in. We'll still take our accredited investors. The whole idea was that we were giving opportunity to them anyways, which we're still going to do. But obviously we can't make people invest that don't want to. The irony is of it that this is actually the best time to be investing. This is frustrating for me. Now, also though, our model is value add strategy. So we are very low on cash flow up front and then high on cash flow as we do the value add strategy and it comes around. So we've had to change a whole bunch of how we're getting capital, on and on and on and on. That laggers into this year. So this year, my main goal has been finding these better, more foundational partners that we're going to work with. We'll slab off, and institutional money and big money, they're all about investing right now. They are wanting to put money to work, right? They're the air quotation smart money. And when times are tough, or even not even tough, it's hard to even call it tough, just not as good as they were in the past, they see discounts and they see good opportunities. We're buying deals at under replacement costs that are brand new, that are halfway full and filling. And we're getting these things at $20, $30, $40 under what they trade at right now on the market. And we're getting them at $10 a square foot under replacement costs. I literally couldn't even replace it. These are the best deals we've seen in a decade. The institutional money, they want it. This is a big change, though, in 2.5 years. And you're going to see this with people and businesses, entrepreneurs, everything else. When markets change, they have to adapt and they have to change and they have to move forward. Change is hard because you built a company and you have infrastructure based upon a certain thing. Then when you have to flip it and change, it's really, really hard on employees. And I don't think I realized that. That was kind of new to me, that big changes would be so hard. And that really affected, I think, my management style, including, because I'm like, I don't understand. Why is this a big deal? We're moving forward, we're changing directions, everything else. But when you build a company and you have structure and outcomes are predicated on the infrastructure that you've built, you have processes, systems, and then you have people that are executing that, right? That makes people worried. Oh, well, if we're changing, am I going to have a job? Things like that. So it overall, tough times and change is hard. Change, especially because of tough time, is hard. And that is something that you have to really talk about and say, and make sure they know and be transparent and where you're trying to go. It doesn't mean that everybody is going to want to go along with it. And that happens. And that's okay. You need to be okay with that. If you're not okay with that, and you try to bring everybody, which I have been one that's hard to release or allow, or feel good about, not allow, but just feel good about certain change up in people, because I want everybody to come along. But that's okay. And you need to be okay with that. And so when we look at 23 moving in, we put tons of money, because I'm also buying businesses. So I just bought another company, and we just started another software company. So we're building out our ecosystem as we're doing this. So as things are changing, we're actually finding the opportunities. I'm consolidating assets. We're buying things and moving forward. This gets into a part of the cycle, though, where we go from being cash on hand heavy, right, to asset heavy. And this is something we have done and we're used to. This happened right after 2008, everything else. Cash is king. You can move that to buy assets because you're buying them at good deals, at discounts, but that means you have less cash on hand. That's how we've been doing it. So 2024, rolling into it, we've now moved into a cycle where we're really asset heavy, and I keep buying companies that I keep doing it. So the next part of the cycle is for us to consolidate physical assets under our new company's management structure and to fuel that with new investment partners. And we're now moving on to where, all right, we want to consolidate fast. We're working with a whole bunch of these family offices that they see the opportunity, they want it. And I've been working on lately in the last few weeks is working on the pitch deck and overall expressing our value, what we're doing and how we're doing it. That's actually really hard. It's really hard because we have existing structures, businesses, and to some people, you're explaining to them your industry right out of the gate, meaning here's self-storage, here's the value, here's what it's like a multiple level value add process. And for me, that's hard for me to boil down because I think everything's important, everything's awesome, and I want to tell you everything, right? That's why I like podcasts, long form. I'm like, guys, here's everything. And I just say everything that there is and why I think it's valuable because I think it all is. So for me, I'm like, okay, we got to really work on this, boil this down because it's got to be easy to communicate to all these other mass parties. And as we went through that and did that, right, we got a lot of the family office are like, great, here, we're doing it. And so we've been working on that, including international. So lately, it has been changing up that funding structure, which is all of my forte right now, where I'm like, this is what I'm doing. This is how I'm restructuring and that kind of stuff. Our other businesses, which has like our CEO and our president, which those are ran by the tech companies, the CEO, the founding guy, Lance there, he's doing it. Our property management side, the Bitterroot side, all of that is done by Sam. He moved in as of this year to take back over, which he had been doing before. So everything, we have running. I have my COOs who execute on my other businesses that I'm the CEO of. And that is, a lot of Ruben on the private equity side, who is an attorney. And he is my COO or my implementer on that side. I have other implementers throughout my other businesses that are executing. I am meant to deal with the structural things, the big structural partnership stuff, how we change, move forward, not the individual execution of employees and onboarding or anything else like that. I used to do that. Obviously, we don't anymore. So when we look at the big changes in 2024, we see us leaving this more high interest rate environment and a lot of those things returning. But it's different and it will be different. And if you don't adapt and change with the market, you're going to miss all the opportunity. So we've invested a ton of money, and we have bought a lot of businesses for this new part of the cycle. So when it goes up, we will be catapulted. This is the exact same thing we did in 2008. When everybody else was running, we were not only buying assets, we were investing and building a company around those assets. This is hard for people because when you buy an asset, you get an asset that's whatever, cash flowing, it pays you money, it's growing in equity, the value is moving up. But when you're investing in the business, you don't see a direct correlation with the ROI. Lots of times it's either out of necessity or things that you need to help you drive that value, but there's just not, right? And so a lot of people, they opt to cut expenses or they opt not to buy the things that drive ROI in a different way. We've done the opposite, and that has paid off big for us, where we invest a lot for long-term ROI. I put my money, invest and build businesses for 10 years out. Assets are from 3 to 6 years out, where I want to turn over my money. It's a very different philosophy, and this has been a big part of what I've been doing. Now, once we leave the self-storage ecosystem, which, by the way, we have if you look at stabilized assets, so that's assets that aren't in fill-up mode because we bought them empty or whatnot, our portfolio is like 85% occupied, which that's kind of target where we want to be. We want to be 85 and then towards the end of the season to 90%, and then it goes down during the slow season. But our portfolio is growing. We have all these assets and we're opening up 2 large new deals, one this week. Don't know when this is going to air, but, and then we have 2 more, one that'll be at the end of the year or the first quarter of next year. So we're still opening up and developing and bringing assets to the market. And in fact, we're excited to do that while other people are like, I don't think it's a great time. That's why we're excited to do it, because other people aren't. Supply, demand works out. So as we look at that on the storage side, we move over to my other businesses. It's important to remember, though, when I talk about this, that the money we're investing is almost always in the business side. We're buying assets, traditional assets, right? We want to turn those assets over, get our money back out, and regurgitate that money. And then our other businesses, we're buying up companies, we're investing in IP, startup companies, my software company, the other one that is not Tenant, that is a startup that has helped to roll in. We're in the middle of that. That's been going for 6 months. We want to have a product out in the next 3 months. And that is still, though, part of our ecosystem. It actually fuels what we do. So I'm investing capital in startups, in intellectual property, in technology, things for the business, right? But I'm also buying, in times like this, we find good deals. And good deals are in other areas, like different industries. So I've also bought up companies in the hunting industry, where they're product-based sales, they have proprietary products and technology, and the product itself is amazing, it's selling great, but the founder is not a business guy, and so the back end, the business side, was suffering to a point where the company was just not going to make it anymore, but the product was growing at 200% a year. Like its sales and everything else. People want it, they need it. It's the only product even on the market that does it. So we buy up those companies. I fix the back end, put it onto my systems I already have. The entrepreneur, he's running and selling the product and he keeps that side going. So I've also been doing a bunch of that stuff. Once again, buying up. This is a time where we look at financially, we're draining cash and we're buying assets. And we're buying opportunistic assets that yield is so disproportionate for the cost that we can buy it at. Now, the time in which we exercise or get that yield back, that is generally unknown. And that is how it works for us, especially when you're dealing opportunistic, which that's what I do. The upside on the equity or that cash flow is generally unknown. We give it a space or a time, 3 to 6 years, right? But that's because I like asymmetrical bets, where it's like the downside is limited, known and low, where the upside is potentially infinite, right? And that is the things that I look at. So the more distressed they are in, or the more problematics, the more the downside is known and can be limited, while the upside is grown even further. So how I get an asymmetrical bet on an asset that potentially has a cap because it only has so many doors is I can get my money back and then I can reinvest it so my money can keep going and moving on. That's how I create asymmetrical bets on that side. I know I can maximize it, measure it, yield it. So this is about churning of capital and building businesses that allow us to do that and expand it. It is not short term. I don't do short term stuff. I build infrastructure. We're talking long term investments. This is hard, everyone. The reason being is the upside generally is unknown, right? When it'll come. The downside's limited. We're getting incredible opportunities. Lots of times it's cash flowing day one. We're just using, most of the time it's cash flowing day one. It is, but we're using that money to reinvest into the asset. So we're not yielding, we're not pulling it out. That means you start to, though, get into like what I've talked about. We're not in a cash base. So prior to the last 2.5 years, we were cash flow and cash on hand, like bank accounts. We just had tons of money sitting around. Everything was so expensive and there wasn't really good deals. Now we're moving to the other part of the cycle where everybody else, it seems like, is trying to get cash on hand. They're trying to pull cash out. So everybody out in the market, they're like, oh, cash is king. They're pulling cash in. We are now saying, nope, get assets and buy. And that is the mode of operation we will be in for the next 1.5 to 2 years. And we need partners that allow us to allocate capital at mass, and we know we'll be there. That's why we're changing in our overall partnership. So our outlay for the following year is twofold. We are going down market in the self-storage market, buying smaller assets in smaller markets, as well as going more into development and opportunistic CO deals that are having problems, and the people that are in it are just real estate investors, and we can buy all those up. The other side of our personal side and our personal financials, I have obviously self-storage income. We have our publishing company. We have our now hunting company. We have our software companies, things like that. But most of those are just startups. They're moving forward. And then we have a few of them that are cash flowing based businesses that are growing. Out of all of those, I am not the executor. So I'm not the implementer. I've partnered up and I have that, and we have employees that are building and running those companies. I am the archetype visionary person that is finding the opportunities. I'm buying them. I'm showing everybody else how we need to do it, what to do. They report back to me as we execute and build. And that's because I've done it time and time again. And that works. And it works really, really well. But this is a balancing act because you can get very cash tight, especially in the game that we play, because we play with big money. We're raising $20, $30 million at a time now. It never used to be like this, everybody. There was a time where the thought of investing $600,000 was so crazy to me. That was so scary that we would get investors' money and everything, and we'd put $600,000 down. There's a time when $100,000 was terrifying to me. It was like $100,000 in the bank account was incredible. That was wild that we had that much money, and I didn't want to lose it. We didn't want to do anything with it, right? It was like, no, don't lose it. Don't spend it because we have it. It's sitting there, and this is amazing. Over 20 years, that obviously has changed because we understand capital, debt, opportunity, but it's something that grew from small opportunities to big. Now, the outcomes today, though, are big, meaning big on the upside, but big on the downside. So then it becomes a different game where we look at risk a lot and we're limiting and measuring and capping out because of that other side. Businesses, too, a lot of people think, oh, they just make money, make a profit, and that's how it works. That's not true. Revenue in business, you guys, goes up, down, up, down. Some years you make good money, other years you don't. You're actually draining money. Revenue isn't set. It's not like income. You don't get a paycheck. Business owners don't work like that. Then the business needs money to grow. It needs money and all this. So capital management is the name of the game. That's what I play. I play a capital management game. I'm going from investors to us. We're going our personal bank accounts over. We're moving capital around. We're buying opportunities, right? And when we started out, it was a cash flow game. We're buying one little asset. I'm trying to get revenue up, limit expenses, get a profit margin, refinance and take it. We're doing the same thing just at a bigger scale. So when you look at today, what we're doing, this is, in my mind, our 2008 period. This is going to take us to the new level. From 2008 to 2019, we grew our company to worth hundreds of millions. Prior to that, we were talking a few million in value. And so now I look at it, this being our next leg and journey. We changed then, we changed now, and we're adapting to the environment. Both of those times, though, are hard. What I see is people, they either back away and say, I'm going to sit out, or they say, oh, the market changed, I'm going to move on to something else. They're going to go do something else, right? And something that's actually working or good. What they don't realize is that's not how economies function. That's not how finance works, right? So you're going to go into something that's winning. That means you're going to catch the downside. And you should be changing and looking at the opportunity in the industries that are struggling because they're about to move to their upside, right? This is contrarian, but building infrastructure around it. So not just buying assets, but the business of buying those assets. Now, I don't want this to sound overcomplicated because it's not, and it wasn't when we started out. In 2008, it wasn't. We looked at individual assets. We focused everything on value. What is the value of this individual asset? Is it worth buying and will it get us our return or not? And then we figured out how to execute on it. We're doing the same thing today. It doesn't change. We just start doing it a lot more and at a bigger scale. But focus on the long term. Like people are like, oh, well, I think it's going to get worse this year. And I'm like, I hope it does so we can buy more. Next year, will it be worse? It may be. I don't know. I'm just going to buy more. Like I don't expect things in a year and a half to either make or break. You can't. That's not how it works. I cannot control markets. So I have to do cash flow management. I have to manage the businesses, our opportunities, right? And we have to try to do asymmetrical bets, and we have to limit our downside, and we build structure to extract that value. Value add, value creation, not leaving it up to the markets. We find value. We find when markets are being not right or when businesses have things that are affecting them that have nothing to do with their core value. I buy them and I take them, I get that discounted, and then we work on being the best and implementing structures, businesses, assets to extract that value and propel it up and the upside of it. And then we recycle. This makes for big swings, though, personally. And I'm telling you as an entrepreneur, and especially if you have a spouse, that you need to be ready for this. And that needs to be okay because your revenue, your income, your cash on hand is not yours. It's the business's, right? So we thrive on the cycles. When all of a sudden cycles are down, it's, you look at, let me explain it like this. You're in a down market, so your cash flow's down. Maybe your income's down, everything else. And then you got to go tell your spouse, yeah, you see how things aren't nearly as good as they were the last 3 years? Yeah, I'm going to go now and spend all our money, and I'm going to double down, and I'm going to start buying, or I'm going to add things, and I'm going to do things. Wait, so let me get this straight. Markets suck. You don't know when they're going to get better. Times are hard. Our income's down. We have all this cash for a rainy day, and now you're going to use that to go buy things that are not doing good, or that the markets may not be as good as they want. But yet I can see the result that it's not having good. And you're like, yeah. So this is hard. This is a hard conversation to have with people, especially when they're not in the business day to day. They don't see those opportunities, know those, understand those things. And this is where a lot of people get. They want one side to be good, meaning that I want business to be doing good. I want to be making a lot of money. And I also want to find value. That doesn't make sense at all. If the industry is doing good and you're making tons of money off of it, and you think you're going to get value that the marketplace is not building in and misplacing, so you're going to get great deals, how does that work? So the whole nature of this is that when you're doing the worst, it's the best time to be spending money and buying. So you got to use that cash on hand. But once again, that means your swings are exaggerated. This is why entrepreneurs always feel like they're either billionaires or going broke. Right? It's an age-old thing, but it's true because they see and they feel the fluctuations of revenue. The key is managing through it because then as you go through the next time, you compound what you were doing in a way that is hard to describe. On those downturns, that leverage, when you buy, you do the work, you don't get paid, you invest your hard-earned money. When you get the results, they're so exaggerated, they blow your mind. And it's like, whoa, the upsides are so good. But then that gets entrepreneurs and investors feeling like, oh, it'll never be bad and I'm just so good and blah, 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 forgetting that the market doesn't care about that. Then they go down and it's just this up and down. So that's where we are in our financials and business, and that's where most commercial real estate investors is. Lots of business. Private equity right now sucks, and it's driven around interest rates. I firmly believe that interest rates are going down, but not in a meaningful way this year. Next year they will. When interest rates go down, assets go up because money gets easier. Valuations rise. I need to be buying and implementing and doing things quickly while we can take advantage before interest rates go down, money gets free, and then people start buying up assets again, and we go to the other side of the cycle. That's where we're at, everybody. Personally, means I work 10 times as hard and I spend 10 times as much money, yet I don't get the corresponding yield from it. Now, most people look at that and say, well, that's stupid. Why are you doing that? And I say, because I know what the yield's going to be like in the next 3 years, which will be mind-blowing, and I'll work very little and my yield will be astronomical. And then people say, you're lucky, because they don't see the corresponding work with the yield. That's it. While you stopped, were playing it safe, were doing things, and you were limiting, I was working 24 hours a day, and I was using all my money, and I was taking big risks. I was buying good opportunities, and I was doing everything that I could. And I did that for years with no corresponding return. And then all of a sudden you have a year where the return starts to come and build up, and then it looks like you don't do a lot, yet you make a ton of money. This is how the cycle works and how it works for entrepreneurs and investors. And the problem is when you think that it shouldn't, when you think that when times are good, I'm going to sit back, or when times are bad, I'm going to sit back, I'm going to play it safe, I'm going to wait it out. And then when times are good, you see everybody else killing it and you wonder, man, why can't I do that? Well, it's because they were doing it when you weren't. And that's the key. It's a big risk. I don't see it as a big risk. Other people see that as a big risk. But to me, I'm like, how is it a risk to buy when things are down and have yield when things are up, as opposed to buy when things are up and not do anything when they're down? It just doesn't make sense to me. So some people see it as a big risk. I actually see it as the much lower risk. It was way more risky if you were buying assets on market 3 years ago with no upside. That was really risky, because then you're just hoping the market goes up, which it wasn't going to. That to me was risky. Today it's way less risk, yet there's less people in the game, hence the reason there's opportunities. So everybody, that's where we're at. That's what I'm doing. I'm investing cash. I'm buying businesses. Our assets are rising, yielding more, which is great to see. So we're already on the turnaround of that, and we are restructuring our businesses and our investor outlay so I can build at mass. We are trying to go out and buy and put down $100 million plus a year in cash to buy assets. That's my goal. That's what we want to do. Because we want to extract the yield. That means our acquisition team, off-market deals, we got to go down market, up market, and it's the hardest time that it's ever been to execute that. So I got to work harder than I've ever had to work. And I'm okay with that because this is fun. It's exciting. And I got to get out there. We got to show our value. We got to show investors what's going on. And even though the short term, they may not yield or not be getting what they want, the long term, it's amazing and incredible. And this is how we invest. Right? It's this whole process that we go through as entrepreneurs and investors. And honestly, you're the one that has to say and show, listen, what we do today will be very meaningful tomorrow. And that's why we do it. And that's why you should be doing it too. They're looking for that guidance. That's easy for me to do because I've been through it. I've seen it, and I'm shocked at the down and the upside. And when you limit your downside, you can take advantage of the upside and you can protect yourself from those downsides. It's like a cheat code, right? And you got to be out there showing others, walking through others. If they're investing with you, you're the expert. So you need to be in control. You need to know what's going on. Even if the news is bad, it's never going to be good. You're never going to have investors. You're never going to have partners or things that are happy all the time because you can't control markets. So you need to be the ones that say, this is part of it. This is okay. In fact, this is an opportunity and we need to move forward with it. And that's where we're at right now. Markets are up on the asset levels. The business levels, not so much. Investment levels, not so much. Things like that. We have the interest rates and we have the elections coming up. So that means you have to do things others aren't. You have to figure out how to capitalize it so you can get what others don't. I hope that helps, and I hope that gives you some insight, which is a brief insight to, I didn't mention all the companies. I didn't mention all the names stuff. I should have actually probably brought out our flow charts and showed it and everything that we're doing, but those are the main ones. And right now we're investing capital, and we are trying to get more investors to leverage it up when, generally speaking, everybody else is going away. I hope that helps you think about markets differently. Don't expect it to come back in fall. Don't expect it to come back next spring. You should be working for 2, 3, 4, 5 years out on short-term investment assets. On long-term business assets, it should be a 10-year goal, right? You should be working, and I'm not saying you should lose money for 10 years. Oh, no. But you should be building for an infrastructure and a business that in 10 years looks a certain way. And then you should be yielding, obviously, in the short term, but you should be maximizing it really 5+ years. That's how it works. You got to hire, you got to buy, you got to build, you got to go to market. There's so much you got to do, right? And there's so much the market has to take and adapt. Unless you're Instagram that can just upload an app, that's great. But anything else, right? It's going to take you a while to get to adaptation. And even the fastest ones still took years. So that's how you should be thinking about it today and why you shouldn't be stopping. In fact, you should be doubling down. And I hope what we're doing shares with you some light. And then you're here, you're listening to me. So you know what? Over the years, you're going to see, and we'll see exactly how these things played out and what bets did good and what bets didn't, what I screwed up on and what I did right on. And that's what I'm here to share with you guys. All right. Enjoy the podcast. The next one we have coming up, you guys, is absolutely awesome. We have our guest, Nick, who was a Navy SEAL. He's coming on. We've got a lineup of incredible guests. So I hope you guys enjoy, and I'll be coming back on to share with you what we're doing, how my businesses are doing, what it looks like, where we're losing, where we're winning, and why we're making the decisions we are. Thanks, everybody.